Welcome back, everyone. We have another episode today with a special guest, Ryan Carriere, who is the bread and butter of this strategy of the STR tax advantage. So, Ryan, thank you for being here today. If we could just start with a 60-second introduction of who you are and what you do.
Yeah, I'm Ryan Carriere. I am the founder and CEO of Carriere Tax Consulting. Basically, we help high-income earners who are looking to use real estate tax strategies, hence one of them being the short-term rental strategy, which probably 90% of my clients are using, as well as cost segregation studies, things like that, to help them pay less tax. That's kind of the ultimate thing that I do. Yeah, I'm a CPA. Been a CPA for about 10 years. I'm a Minnesota native, have a few kids with one on the way, and hopefully that's nice and short for your audience.
That's perfect. And how did you get into this strategy? Like, what took you towards this niche in particular?
So most Americans are W-2 employees compared to business owners. And what I really like about this strategy is that you could have two spouses, both working full-time W-2 jobs, who could still use real estate tax strategies like the short-term rental strategy. Comparing that to real estate professional status. Real estate professional status, you have to have a spouse that's basically dedicated to real estate almost full-time, at least more than half their time in 750 hours, but that does not need to be required for the short-term rental strategy. So it's just a very broad way for people to diversify and get into real estate, which is why I like it, as well as be able to take the tax savings to offset things like their W-2. If they are a business owner, great, but to be able to get those tax savings that people are looking for.
Yeah, awesome. And yeah, at a high level, can we talk about like why STRs in particular are so powerful compared to, let's say, a long-term rental?
Yeah. I like short-term rentals because they generally can produce more cash flow as long as you buy a good property in a good location that is okay with the regulations. Obviously, that's something that always should be considered with regulations, but just assuming we found, a good vacation rental market, something that's been in existence for probably a few decades, that's been standard. It's not like we're trying to buy in New York City and it's like, oh my gosh, now we've got all these short-term rentals. What are we going to do? Let's ban them, right? We don't want that kind of an issue. And then we've got the regulations are good. It's a proven kind of area. The economy is driven by tourism, things like that. That's all good. But yeah, just generally, I've seen from my clients higher cash flow. It is a little bit more intensive. It's more hospitality than being just a sole landlord. But I think with the fact that you're running more of a hospitality and combining that with the tech that's out there with things like, property management systems and all these things, I just think that makes it a lot easier for a lot of people to do this. So great cash flow. I do think that it also has a unique ability for you to actually use the space, right? If you bought a 12-unit apartment building, you're probably not going to stay at one of those units for a year or a week or something like that. But you could, right? If you bought a property in Destin, Florida, and you're like, hey, we like to go to Destin, Florida for a week or two every year. Cool. If it's something that's vacant or you want to block it off, you could go stay there, right? We got to be careful about personal use. And we could talk about that if we want to prioritize that today with our time. But that's some of the reasons why I like the short-term rentals.
Yeah, and from a tax perspective, could we talk about that a bit for STRs versus LTRs? And I know you mentioned someone with a W-2. So how can they use these short-term rentals to hopefully reduce their taxes?
Yeah. So for most people with W-2s, they're not going to meet real estate professional status because that's kind of the which one are we going with, right? The two main strategies, real estate professional status. I just want to have people think long-term rentals, or the short-term rental strategy, which is short-term rentals, right? Pretty obvious. So with that, long-term rentals and reps, you would have to meet 750 hours in more than half your time in a real property trade or business. If you're full-time W-2, especially if both spouses are doing that, you're not going to work 2,000 hours in your W-2 and then 2,001 hours in some other real estate business. Very, very, very unlikely, and just has a whole lot of risk trying to claim that. So basically, that's why I like this, and we were kind of talking about that a few minutes ago. So if we take off the long-term rentals for tax savings, because if you don't meet it and you had long-term rentals, those losses are just passive. Okay, you don't lose them, but they get suspended and carried forward, but you can't use it to offset your W-2. Okay, so in contrast, the short-term rental strategy, basically, as we talk about this more, it's really two steps. Average stay is 7 days or less, meaning 7.00000. You get the point, or less. Okay, and that is an exception to what the IRS considers a rental activity, making it not by nature or by default being passive, but taking it out of now being considered a rental. Okay. Now, the second part to that, step two, is that you have to materially participate in your short-term rental, or if you've got multiple short-term rentals. Okay. And in order to do that, the IRS has given us 7 different tests. The two most popular that I've seen my clients use is number 1, the 100 hours and more than anyone else test. We'll kind of talk about that more, I think, as we go. But then the second one is the 500-hour test, which is basically you get 500 hours. The IRS is like, that's a lot of time, roughly 10 hours a week, for the sake of a full year. You don't have to compare your time to anyone else then at that point. Yep. So that's why I think W-2 earners especially, or just busy people, are moving towards the short-term rentals, because you don't have to get 750 hours, right? If you compared that to what I just said, you could literally get 105 hours, right? So it's like a seventh or an eighth of the time that's required in order to take losses from your real estate and offset your W-2 or business profits. So time requirement is less. It's a lot more available and open to others. It still requires time, right? You've got to materially participate. You've got to put that in. And we can talk through what time counts, what time doesn't here in a second. But that's why people are moving into this. And that's why, from a tax perspective, it's just more attractive than long-term rentals right now.
Yeah. And I mean, one of the things too is the bonus depreciation play. So can we talk about what that is and why it matters in this context?
Yeah. So assume we've met the short-term rental strategy, average stay less than 7, you've materially participated. That's only, all it does is turns the property from what would have been by default passive to now being in kind of this non-passive bucket. Okay, which your W-2 is in the same bucket, all non-passive. Okay, non-passive can offset non-passive. But if we want to take the most advantage of that loss, now that it's non-passive, we're then going to try to accelerate as much depreciation into that short-term rental as humanly possible. And how you get that from, say, $1 million purchase is you go get a cost segregation study, an engineer, or there are software studies out there as well. They're basically going to figure out, okay, of your $1 million purchase, how much of this should be into the bonus eligible property? And because we're here in 2026, we've got 100% bonus depreciation back. If we use the kind of rule of thumb that I'll just use for the sake of answering your question, say it's about 20% of your purchase. Okay, $1 million purchase, say 20% of that is your bonus eligible property, 5 or 15-year property. We could then accelerate $200,000 of depreciation extra in that first year. And that's going to use, to offset your W-2. So we're back in because of the One Big Beautiful Bill that came out July 4th, 2025. Here in 2026, we've got 100% bonus depreciation back. So it's kind of this combo, short-term rental strategy plus a cost segregation study on that short-term rental. That's going to generate a whole lot of extra deductions to offset your W-2.
Right. Yep. So just like simply recapping it, it's like the average length of stay, 7 days or less. And then we need to materially participate, which we could talk about a little bit more, but that means you are actively participating in the operations of this property or this investment. And then we go ahead and get what's called a cost segregation study, and that allows us to qualify for bonus depreciation. And then talking about a little bit more about like who this is a good fit for, like we alluded it to, you said 90% of your clients are using this strategy. Like what's the avatar of someone where this is a no-brainer? And then on the opposite end, what's the avatar of a client you've worked with where you're saying, hey, maybe we should actually not consider doing this? So who's this a good fit for? Who's this not a good fit for?
Yeah, a really good fit for anyone in like the 35 or 37% tax brackets. So that'd roughly be $500,000 or more. Just depends if you're single or married. But if you're over that income bracket, like every extra dollar we can get you is pretty efficient. 37 to 35% of every dollar we can get in the form of tax savings. And they're willing to put in the time. Yeah, that's a qualifier that I have when I talk to people, as they're like, hey, I've got 0 rentals right now, but I've heard of the short-term rental strategy. I think I'm going to buy something this year. And sometimes I'll ask people, okay, are you willing to put in the time? And they're like, no, not really. I'm wanting to just kind of invest and then be hands off. And I'm like, well, you're not materially participating, so I'm probably not going to help you really that much, because this is just going to be passive, right? It's not going to make sense to do a cost segregation study. It's not going to make sense to do all this tax planning and then find out you can't use it for years to come because it's passive, right? Yeah. So I'd say someone making income level $500,000 or more, that's 35, 37% tax bracket. Someone who's willing to put in the time, but someone who also is fairly busy and not already in real estate. Meaning we're not talking to like a real estate agent. We're not talking to like a wholesaler, a flipper. They're in real property trades or businesses, and they probably are pursuing real estate professional status, right? Right. So if you've got 2 busy W-2 employees getting you to that very high income, right, between the 2 of them, that's a much better fit. So income, the industry they're in, and willing to put in the time. Those are kind of 3 that I think.
Yeah, 100%. So let's go off that, like the material participation, qualification, and like the easiest ways to actually qualify for material participation. You're talking about actually needing to spend the time. And as an operator, that manages 70 of these short-term rentals, we understand the time that it takes to operate it because it is a hospitality business. So what are some of the ways, and I'm sure you're looking at, time studies or time trackers, and you've seen plenty of those. What are some of the easiest ways that people can qualify for material participation if they're going after 100 or 500 hour, one of those rules?
I almost always recommend people go to their property. Okay. Doesn't mean you need to spend a month there, but I would recommend that you spend at least a few days, if not like a week or two. Okay.
Yeah.
And if you're a W-2 employee, you probably have what's standard in the US, a week or two of PTO, right? And if you're uncomfortable saying, hey, I'm not going to spend my PTO going to my property to get material participation, well then, okay, find out some way that you're going to go to the property because let's say, for example, you need to get 100 hours. Okay. Mm-hmm. If you're married, which is a lot of my clients, most of my clients are married. Let's say both of you and your spouse go to the short-term rental. You arrive there on a Sunday and you leave on Saturday night or Sunday. You're there for your 7 days. Okay. Mm-hmm. If you're working basically every day, you and your spouse, okay, from 8 to even 5, okay, whatever that math comes to, 5 plus 4, 9, 9 times 2 times 7, right? That's going to get you over 100 hours if I'm not mistaken. Okay. That's going to immediately within 1 week get you over 100 hours, especially if both spouses can do this together. Because that's a unique thing that most people forget is that spouses can combine their time as long as you're married filing joint. If you're married filing separate, no, you cannot. Okay. If you're single, obviously you're by yourself. But if you're married filing joint, spouses can combine their time. So if I'm married with my wife and I'm doing these things for 8 hours, she's doing these things for 8 hours, well, we got 16 hours in one day. Right? Yeah. So we're almost there. 16 out of 100, we're 16% done. And we literally spent 1 day. Right? Yeah. So there's kind of this multiplication if you can do it together, and you can kind of dedicate a full week. If you've got kids, and especially if they're young like us, it can be really difficult to do that. Right. Either one spouse has to be heavy in it, or kind of, just one spouse is doing what they can in there. Yeah. That's a very practical way for people to do it. So one is physically going there. Mm-hmm. Number two, and that's kind of the obvious ones to get for material participation. The second one, though, is some level of management. Okay. Now, a common misconception I get is that, Ryan, if I hire a property manager or a co-host, that means I cannot materially participate. And I would say, where does it say that? Because it doesn't. What we're trying to just do is make sure you get your minimum of 100 and you have more than your cleaner, your handyman, your co-host, whatever it is, right? Think of it like a bar chart. That's why I'm using my hands like this if you're watching. So that's how I think of it. What's the bar chart say? If you're at the top and you've got that minimum of at least 100, you're good. It doesn't matter if you're doing a little bit of self-management, zero self-management, as long as the time you get is truly material participation and it's more than anyone else that you've got documented, you're good. So again, physical time, repairs, improvements, cleaning, furnishing the property, those would be good examples. Self-managing, where you're setting up the listing, you're writing the descriptions, you're writing the guidebook, you're messaging guests, you're doing refunds, all that kind of managerial stuff would all count. Those are like the two most simple, easy to follow examples of what we do material.
Yeah, I think it can be confusing too if we're going off the 100 hour or more than anyone else. And let's say we are hiring a property manager, because as property managers, we do have clients that go about this strategy with us in place as property managers. Tell us about tracking those hours, and how do we know we're spending more time than the PM, the cleaner, the handyman, whoever else might be active in operating that property?
Yeah. So at the very least, at the end of the year, you should be asking your cleaner, handyman, property manager, co-host, whatever it is, asking them for their time. You do not necessarily need to have some sort of detailed time log like yours needs to be as the taxpayer, as the client, but you need to get some sort of summary to say, hey, they told me on my property that they spent 50 hours. I'm going to write that down, right? I'm going to put this in my kind of spreadsheet, and I'm going to show, hey, I got it my 105. Manager A got 50. Manager B got 25. Manager C got 20. And that's a key point I want to highlight too. This is comparing your time to any other individual. It is not the summary of a company where you've got 3 people. That's 3 individuals you're looking at, right? So it's not looking at the company as a whole. So if you hire your company and you're like, hey, I've got 3 employees doing this, you're looking at each individual employee. And if you guys are cleaners, for another example, if those cleans or the management gets spread out amongst multiple people, it just becomes almost a no-brainer. Like, I'll send you the time, but compared to yours, when we spread it out evenly, instead of it all being with one person, it's just going to be a lot less of an issue. We just need to then document it appropriately.
That's a super super valuable distinction, because also thinking about what cleaning team to work with could be now a new consideration. Rather than working with one solo cleaner, we might consider a cleaning team where there's now 3 potential cleaners that are going to split up their time between those 3 individuals, which will be much more likely to qualify for more hours than them. So that's a really, really important distinction there. And I appreciate you sharing that. What are some mistakes people make here when they're qualifying for material participation, whether it's the tracking process, whether it's potentially tracking the wrong things or adding things that might not actually qualify for material participation? What do you see that some people make a mistake on there?
Yeah, a couple of things that popped in my head. One would be, so think of it like a spreadsheet. That's usually the easiest way to explain it, and most people are going to use a spreadsheet anyway. So think of 5 different columns. Okay, 5 things, five fingers here. Number 1 is the date. Okay, think every single row should be its own day. Okay, what I see, unfortunately, is that some people take a whole row and it'll be everything they did that week. Okay, that's just too vague, right? It's like, okay, well, what day did you do this, or what day did you do this, right? And there's no distinction there, and it looks like you just kind of made something up, right, for the whole week. It's not clear and accurate, is what we're concerned about. The second thing is when it comes to the time. Okay, how many hours or minutes did you get? People will oftentimes round everything to the nearest hour. Okay, really? Everything took you exactly to the nearest hour, right? Yeah. That looks made up again, right? It looks like an estimate, and it looks vague, okay? Not accuracy, vague. The IRS doesn't like that. So round to the nearest minute, 5-minute, 10-minute, 15-minute increments. Just pick something and do that and stay with it. The third thing is the description. It's way too vague. Worked on my property. Okay, what kind of work did you do? Were you were you cleaning the unit? Were you furnishing it? Were you working on some sort of repair? Okay, describe that. Okay, otherwise it's too vague. Number 4 is not putting which property they were working on. So that's the where, right? Especially if you have multiple, that's a concern. Okay. We want to be clear on which one were you working for. Okay. Yeah. And then number 5 is which person, meaning the who, between you or your spouse. If you're single, it's obvious, right? Yeah. But if you're married, it's good to put, hey, this person was doing this for this long and this person was doing that for that long. Because I had a client recently this year sent me a time log, and for last year, they put January 30th, 30 hours. And I was like, dude, how many hours are in a day? Right? And I was like, okay, it's 24 hours. So come to find out, both spouses were working 15 hours, but that wasn't on there. And people have lost in tax court by sending silly documentation like that, where the IRS is like, hey, dude, how many hours are in a day? 24. Okay, your thing here says 25. Good luck, goodbye. We're disallowing the whole thing. Like silly little things like that will completely destroy everything you tried to do. Okay. Yeah. That's why you work with someone, 1, who's actually knows how to look through this and see what silly mistakes you're making. But 2, you're thinking logically about, I need to have a lot of details and accuracy, and putting in if both spouses are working, that equates to more than 30 hours in a day. We're splitting that out so that it looks reasonable to a third party, right? Yeah. So those are some of the common ones. We can get into time that doesn't. Ultimately, it's kind of investor hours, meaning you're just kind of looking at things that a property manager sends you, like a statement, a monthly statement. It would be education. I would even say, like, just looking at this course and doing this, I would be very careful including this as material participation. It's kind of general education. Third would be research. That would be looking on the MLS for properties. That's kind of part of the due diligence. Right. And then 4th is travel time. Travel time can be an issue. There are certain ways it can count, but you've got to be very specific in how you meet that. And I just generally tell people, please don't try to rely upon travel time to make it work. Yeah. Makes a lot of sense.
How about actually tracking these hours? Like any tools, any software, as you mentioned, a spreadsheet. I don't know if you have a template that you typically use. Like, how should someone do that?
Yeah, I would say 80 to 90% of my clients use a spreadsheet. I do have a template that I send to my clients that use it. There's nothing really cute and fancy about it, to be honest. It's literally kind of those 5 columns, and then just making sure you're kind of religious and tracking all of those things on a daily basis if you're there, making sure you're keeping track. But there is time tracking apps out there. There are a couple. Sure, you could use them. I think some of them don't do a good job. They kind of include things that I would say do not include into material participation. So it's kind of leading you astray as like, here's a category on this app from a non-CPA saying that I can include this. And I'd say, whoa, are they going to sign off on your time log and defend you in an audit? If not, then what are you doing listening to them, right? So you just have to be careful of using those apps that are even more real estate specific, because they could kind of lead you astray. And you want to make sure if you're going to use them, fine. You need to though run it by your CPA to say, hey, here's what I'm going to include Are you good with that? Does that make sense? Yep. Although they gave you this broad category, just know this piece of this is going to count or this piece is not. And we need to rework this a little bit.
Yeah, yeah. And when does it start? So someone's doing the due diligence, they're on the MLS looking at properties. Like, when do they truly start, hey, Ryan, we're going to download your spreadsheet? Like, what's day one of tracking your hours?
Once you're under contract. That is the simplest way to think about it. Anything pre-contract, I would not include in my time log, just because everything you're doing pre-contract is research time effectively, because you might get on the MLS and look at 30 properties on your phone, right? Something like that. And keep in mind, in order to get material participation, it has to be tied to your property. So if you looked at 29 other properties that you never bought, what are you doing? Like, that doesn't count. It's not material participation to the property you bought. Okay. But even at the end of the day, you might also think about, well, what about like working with my lender or creating a bank account or an LLC? I would include all of that kind of stuff as kind of investor research time, right? Because you're just kind of getting things ready like an investor, because anyone is going to have to do that, right? But to be materially participating, you've got to be involved in something that's going to move the needle on operations or taking care of the property or talking to your actual customers, aka your guests.
Yeah. Makes sense. So you get under contract, you start your time log, you have your breakdowns in each column, knowing when you did it, knowing what you did, knowing who did it, knowing where you did it, all those things. So let's say someone has a great time log. What's next? Like, what's that next step of the process? And then beyond that, where do you get involved? Like, as a tax strategist?
I like to get involved either as part of the buying process, because I can actually look at a couple of properties that they're looking at and say, hey, we're doing our due diligence. We've looked at 30. We think we've narrowed it down to these 2 that we really like. I can pull them up and I can kind of do my own like pseudo tax analysis to say, this one's going to get you actually a lot more tax savings if you go with this one, because right? And I can kind of list off a couple things to say this one's going to get you more, even though to you they might look similar. I know how to look at things a little bit different, right, from a tax perspective. So that's one part I like to get involved in, is even being under contract, especially if clients are like, I've got the capital. Yes, we're going to do this. We're actively looking. We're putting in offers. Great. That's a good time for me to get involved. Otherwise, as they're moving forward, I'm usually reviewing that time log 2 times a year. Say, hey, we're kind of halfway through the year. We've done this for a few months. Can you take a look, give us some feedback? And I'm walking them through that. And as well as we get right towards the end of the year, like November, December, I like to review that time log again to say, hey, are we on track? Are we over? Do we need to work a little bit over Christmas or something like that to make this all work? Just to make sure we don't get to January 5th and it's like, you guys didn't do it. You're like, what? Like, well, why didn't we just meet a couple weeks earlier to make sure that we actually did all this correctly, right? So that's usually where I get involved. But yeah, as you're documenting things like that, if we're very clear that this is going to work, then we're talking about getting a cost segregation study done. Who are we going to use? How much is that going to cost? When do we want to get that done? What are those results going to look like? And then if we are very confident we're going to meet that, yeah, let's get it done before the end of the year. You don't have to. That's a common misconception. People think they have to get it done by December 31st. As long as you have it before you file your tax return, you're fine.
Okay, got it. And then yeah. So is there anything else they should have prepared on their end? I think we covered most of it, but before they talk to you, anything else you want them showing up with? Materials, resources, documents, information, just to begin the relationship with someone like yourself?
I think as long as they've got capital ready to go, starting to get serious about putting in offers, starting to look at markets, or they're already under contract, any of those things would be a qualifier to say, yeah, now's a good time to start looking. If you're like, hey, we're going to buy something maybe, or we're going to buy something next year, I'd say, okay, hold off. Let's wait till either the end of this year to start working together or just later. Or if you're like, yeah, more urgent, this is like a pretty soon thing and this is a for sure thing that we're going to plan to do, then we could get started anytime.
Yeah. And what happens if someone, let's say, goes about it on their own, or they join this program and they don't meet you or hear about you until, maybe they're already 9 months in? What does it look like if someone, does this on their own, or let's say if they potentially do it incorrectly?
If they do it on their own, or they come to me towards the end of the year, it's not the first time it's happened. It's honestly happens more often than I would love to see people do, just because it's a little bit more reactive in terms of like, hey, here's the things that you have been counting that don't count, or here's the things that have been counting that you should, or you need to tweak your time log and doing this and that. So it's a little bit reactive on their aspects, but you're basically just taking on more risk. Because you're not a tax strategist, you haven't reviewed all the court cases I have, you don't know what the IRS is looking for, you don't know how to put this time log together, all those things. I'm telling you this kind of the generalities here, because I'm not talking to a specific person that's like, hey, for your situation, we want to do this and this and this and this. You're doing these activities. Okay, this is going to count, but this isn't because of these things. Right? Like it gets very granular once we work it through. But if you're coming to me late, it's either, hey, I'm catching you up on what time counts or doesn't. But also, if it's like a whole year later and you haven't put together a time log, that can start to be an issue, because the IRS could, if you sent them a spreadsheet in a file, they could potentially look at when was the last time this was saved or when was this created, okay? And they can look at those things to say, is this contemporaneous? Meaning, is this contemporary? Have you been doing this on a timely basis? Okay. If you were to be audited for a tax return in 2023 and they got you a letter in 2026 and they see, hey, this file was created, this spreadsheet was created on January 5th, 2026, and they last updated it, May 18th, 2026, that's going to be a red flag. Okay.
Yeah.
So point is, there can be a little bit of catch up, especially if it's well before an audit, but there's just a risk that you actually didn't meet it. Or you're now feeling like the pressure, you have to fabricate stuff, and now you're lying, and you probably don't feel super great about that, in order to catch up to make sure that you're actually doing this correctly. So those of you who are probably watching probably don't want to do that. No one really wants to, but sometimes they feel like the pressure is too high to get these tax savings that they feel like they have to do that.
Yeah. And how about just general advice? So someone is, let's say they're making a 500K or more, where this would really make a lot of sense for them to pursue. Any general advice for that person that's, about to pull the trigger, or maybe they're a little timid, that, could be helpful for them to hear?
First and foremost, make sure if this is your first one, and if you're not working with any sort of a specialist realtor or a specialist management company or a specialist short-term rental acquisition firm, that you first and foremost know the regulations. Like I have even made mistakes, and regulations are constantly changing, where I've misunderstood. Like I did a YouTube video once on one in Gulf Shores, Alabama. And like I was doing my kind of walkthrough, and I got to the end and I was like, this description doesn't say anything about short-term rental or permit or anything. I did a quick search and it was like, nope, you can't do short-term rentals here. Specifically like this area in Gulf Shores or something like that. And I was like, shoot. And I walked through all this analysis. I spent all this time and then I can't even do this. So that's the first and foremost thing you want to do, is make sure regulations are good. But I would also say, if this is your first rental, know that this is partly a diversification play. Most people who are in these 500K income brackets, you've got so much in your home. You've got a bunch in like your IRAs, your 401ks. That's all in mostly stocks, except for your home, right? Hopefully you don't see that as like an investment, sure, a micro and whatnot. But you're now kind of diversifying into a new form of asset class that can now appreciate. You've got debt pay down, you've got cash flow, like we were talking about. And now, if you do the short-term rental strategy, 7-day average, material participation, all that, and you do cost seg, now you're adding in unique tax savings that most of that stuff just can only do at such a small amount, right? You can only contribute 24 grand or whatever it is to your 401k. Okay, we're talking about a $100,000 deduction, not a $24,000 deduction. Okay, so just the amount that we can kind of scale to get to 100 hours every year, but get you a $100,000 deduction every year, that's huge. Okay, so see this as hopefully that you are first and foremost looking at and doing good due diligence to find a good property, good location, tourism market, regulations are good, all those things, first and foremost. And the investment, this is my last thing I'll say. General advice, do not let the tail wag the dog. The investment itself needs to be sound. Let the tax savings be the cherry on top, even though people are Googling and searching for tax savings W-2. This is a good one. If this intrigues you, fantastic. But now that you know this can provide tax savings, don't let that be the sole reason that you buy a crappy investment, because then you're just going to be losing money all the time, and you're going to be like, I got to sell this thing in 3 years. And then guess what? You got to pay all that back via depreciation recapture. Okay, so this is meant to be a long-term play. This is not meant to be a get-rich-quick scheme at all. This is like, hey, I hold this, I get my accelerated depreciation, and I'm planning to hold this for a long time.
That's great advice. That's really good advice. And like, make sure the numbers make sense before the tax advantage. And like you said, like this is just that cherry on top. So I love that. So if someone's serious about this and wants to talk to you, like what is the best next step, and what does it look like to work with you and your firm?
So you can find me a couple places. CarriereTaxConsulting.com is my website. I'm very active on LinkedIn pretty much every day. Ryan Carriere CPA. I also just started a YouTube channel a few months ago, so you can check me out there, Ryan Carriere CPA. So go check those out if you're interested of me, how I write, my services, things like that. If you want to take the next step and you want to talk to me, book a discovery meeting with me. Those are free at this point. And we'll just kind of talk through 30 minutes. Hey, what do you have going on? What's your issues? What's your income? How many rentals do you have? Are you buying your first one? What's your purchase price? How much capital do you have? What's the timing? What's your market? And that's just going to help me get an understanding of, do I think that I can see tax savings above and beyond my actual fees? Okay. And if I don't see that, I will be very honest with you. I've turned a lot of people away making 100 grand, 200 grand. It's like, hey man, this isn't going to work. Like your savings are going to be X, my fee is Y. We might be doubling tax savings, but after all the fees that you're going to incur, is that really going to be worth it for you to save, 2 grand at the end of the day after all the fees? For most people, that's not going to make sense. So we'll have a discovery meeting. I'll walk you through everything, hear what's going on. I'll walk you through my services, my pricing, things like that. And then we'll talk about next steps.
Cool. Yeah. And we'll have a link in the show notes. So if you want to book that call with Ryan, just click that link, book that discovery call. As you can see, he knows so much about this strategy and is a wealth of knowledge in the space. So Ryan, thank you for your time, and we'll see y'all on the next module.